there are two important methods to calculate depreciation. One is straight line method, other one is written down value method, or it is also called as diminishing balance method. But under written down value method, as and when the asset value goes on decreasing, we are going to calculate on the reduced value of an asset. In case of written down value method, the value of depreciation goes on diminishing, because each and every year we are going to calculate the depreciation on written down value of that particular asset. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidhyaashram PU College, the Temple of Excellence, Mysuru. My dear students, we were discussing about the chapter 7, that is from part B, first PUC Accountancy syllabus, that is chapter name is Depreciation, Provisions and Reserves. Already we have discussed few of the concepts and today we are in the 7th session of this chapter. So let us quickly recall what we have discussed in a previous session. So in a previous session, I have covered this topic, that is we were discussing about calculation of depreciation under straight line method. Now what do you mean by straight line method? Here the value of depreciation will be same unless if there is any additional asset is been purchased or if any asset is been sold in between. Unless in that situation, the value of depreciation will be same year after year. So it is known as what? Straight line method. And always we are going to calculate depreciation on original cost of the asset. So straight line method is also called as original cost method. So this is a 12 marks problem what we have discussed in a previous session, that is problems on calculation of depreciation under straight line method, or it is also called as original cost method. In today's session we shall continue with one more type of method, that is I have already told you there are two important methods to calculate depreciation. One is straight line method, other one is written down value method, or it is also called as diminishing balance method. So we have already discussed about straight line method. In today's session, we are going to continue with problems on diminishing balance method or written down value method. Now, what do you mean by written down value method or diminishing balance method? So, written down value method, it is also called as WDV, that is written down value, or reducing balance method, or it is also called as diminishing balance method. Now, here the value of depreciation, we are not going to calculate as like straight line method, we are not going to calculate on the original cost of the asset, but we are going to calculate on the reduced value of an asset. So that is why it is called as written down value method. For example, in straight line method, suppose the original cost of the asset is rupees 1 lakh. Okay, so in the first year we are going to calculate on this 1 lakh itself, that is on original cost. Now in the second year, suppose the value has been reduced to 90,000. Under straight line method, so what we are going to do, we are not going to calculate in the second year, also we are going to calculate on this original cost itself, that is on 1 lakh. We are not going to calculate on the reduced value. So it is called as straight line method, because always we are going to calculate on this value itself, that is on original cost. But under written down value method, what happens? Here, suppose the value of asset is 1 lakh in the first year. In the first year, we are going to calculate on this 1 lakh itself. And in the second year, suppose if the value of an asset has been reduced to 90,000. In the second year, we are going to calculate depreciation on this reduced value, that is on 90,000, not on the original cost. So this would be the main difference between straight line method and written down value method. In straight line method, even though the value of an asset will reduce, we are going to calculate on the original cost only. But under written down value method, as and when the asset value goes on decreasing, we are going to calculate on the reduced value of an asset. So it is called as written down value method or reducing balance method or diminishing balance method. So you'll clearly understand when we solve a particular problem on this type of method. Now we shall go through the problem in this particular session. Now go through the problem here. TVS Motor Limited. So TVS Motor Limited is a company. So they have purchased a machinery on April 1st, 2013. And I have clearly told you we have to be very careful with the dates here. Okay. So when did they purchase a machine? On 1st April 2013. So they have purchased a machine. Now what is the original cost of the machine? So 2 lakh and spent rupees 10,000. So purchase price is 2 lakh and spent 10,000 for its installation. So how do we calculate the original cost? So original cost is equal to purchase price. Purchase price is rupees 2 lakh plus installation charges, that is rupees 10,000. So the original cost will be rupees 2,10,000. So this will be the original cost of the asset, that is 2,10,000. Depreciation is provided at 10% per annum. So what is the percentage of depreciation? 10% per annum on written down value basis. So we are going to follow which method? Written down value method. Prepare machinery account and depreciation account. So we have to prepare both the account, that is machinery account and depreciation account for first 4 years. Now they have clearly told we are going to prepare account for first 4 years. So we have to write the date for first 4 years, correct? So we have purchased a machine on 1/4/2013. So the year ending will be 31st March 2014. So this is the first year. Now second year 1/4/2014 to 31st March 2015. Now coming to the third year 1/4/2015 to 31st March 2016. Now fourth year 1/4/2016 to 31st March 2017. So these are the first 4 years where we have to prepare machinery account and depreciation account. Books are closed on 31st March every year. Of course, we have closed our financial year on 31st March every year. So hope you are clear with the problem. Now we shall directly go through the solution. Anyhow, we have calculated the original cost of the asset, that is purchase price plus this installation charges, that is 2 lakh plus 10,000, 2,10,000. Okay. Next, we know the dates when we have to prepare the accounts. Now we shall directly go through the solution here. First, we have to prepare which account? That is machinery account. So you know the format of machinery account. So we'll be having debit as well as credit side. Under debit side, date, particulars, journal folio, amount. Again, credit side, date, particulars, journal folio and amount. Now, what are the entries that has to be recorded under machinery account and depreciation account? So, I have already told you. So, the first entry is for what? Purchase of asset. So, here the asset is machinery. So, what is the entry? Machinery account debtor to bank account. So, this is the first entry for purchase of machinery. Machinery account debtor to bank account. Why we are debiting machinery? Because machinery comes to the business. And why we are crediting bank? Because bank or cash goes out of the business. Now, second entry is for what? Charging depreciation. So, what is the entry? Depreciation account debtor. Depreciation account debtor to asset. Here the asset is machinery. So, to machinery account. So, this is for charging depreciation, and normally depreciation is charged at the end of the financial year. That is, at the end of each and every financial year, we have to charge the depreciation. So, your entry will be depreciation account debtor to machinery account. The third entry, transfer of depreciation to profit and loss account. Now, in the second entry, if you see here, we have debited depreciation account. We have to transfer that depreciation to profit and loss account. So, what is the entry? Profit and loss account debtor to depreciation account. So, to depreciation account. So, these are the entries that we have to know while preparing machinery account as well as depreciation account. Now, we shall directly come to the entries here. First, we are going to prepare machinery account. The first entry is for purchase of machinery. Your entry will be machinery account debtor to bank account. Correct? So, when did we purchase a machine? 1/4/2013. 13. So what is entry? 1/4/2013. Machinery account data to bank account. So right here, to bank account. What is the original cost? 2 lakh plus 10,000. That is 2 lakh 10,000. Now in that particular year, there is no additional machinery is been purchased. At the same time, this machinery is not sold also. So we have to calculate depreciation for the whole year. So 31st-3/2014, that is end of the first year, 31st-3/2014 by depreciation account. Now in the first year, we are going to calculate on the original cost, that is 2 lakh 10,000, and what is the percentage? Here clearly they have given, that is 10%. So into 10%, that is 10 divided by 100, will get 21,000. Now balance both the side. Balancing figure has to be carried down for the next year. Now in the debit side, it is 2 lakh 10,000, whereas in the credit side, we have only 21,000. So the balancing figure 2 lakh 10,000 minus 21,000 will get the balancing figure of 1 lakh 89,000. So what is this? 31st-3/2014, we have to carry down that balance. It is end of the financial year. By balance carried down 1 lakh 89,000. Now we are done with first year. Now coming to the next year. So next year beginning. So what is the date? 1/4/2014. So second year, 1/4/2014, to balance brought down. Whatever the amount you have carried down in the previous year, bring down that balance. So to balance brought down 1 lakh 89,000. Now since we are following written down value method, now in the second year, we are going to calculate on this value, that is on reduced value. Okay. So second year, 31st-3/2015, we have to charge the depreciation, correct? So by depreciation account, now remember in straight line method what we used to do, we are going to calculate on the original cost in the second year also. But under written down value method, we are going to calculate on this reduced value, that is 1 lakh 89,000. That is after deducting the depreciation. So the original cost was 2 lakh 10,000 minus 21,000 depreciation. So the balancing figure was 1 lakh 89,000. Now on this value, we have to charge the depreciation. 1 lakh 89,000 into 10% will get 18,900. Hope you are clear with this. Now we have to balance both the side. In the debit side, it is 1 lakh 89,000. Whereas in the credit side, we have only 18,900. So 1 lakh 89,000 minus 18,900 will get a balancing figure of 1 lakh 70,100. What is this? Balance carried down for the next year. 31st-3/2015, by balance carried down 1 lakh 70,100. Now we are done with 2 years. Now coming to the third year. That is 1/4/2015. That is next year beginning. To balance brought down 1 lakh 70,100. That is the balance carried down of the previous year. Now end of third year, that is 31st-3/2016, we have to charge the depreciation by depreciation account. Now on which value you are going to charge the depreciation? On the reduced value, that is 1 lakh 70,100 into 10%. So you'll get 17,010. So this will be the depreciation for the third year. Now balance both the side. Debit side, it is 1 lakh 70,100. So write 1 lakh 70,100 minus 17,010. You'll get a balancing figure of 1 lakh 53,090. So this is a balancing figure of third year. So 31st-3/2016, by balance carried down 1 lakh 53,090. Now coming to the fourth year, whatever the amount you have carried down in the end of third year, bring down that balance. 1/4/2016, to balance brought down 1 lakh 53,090. You have brought down the balance. Now you have to charge the depreciation. So depreciation is charged at the end of the fourth year, 31st-3/2017, by depreciation account. Now we are going to calculate depreciation on which amount? That is on written down value amount. That is 1 lakh 53,090 into 10%. So you'll get 15,309. Hope you are clear with charging depreciation under written down value method. Here you are going to calculate on this method, this value. Here also in the fourth year, you are going to calculate on this reduced value. Now balance both the side. Debit side it is 1,53,090. Here also it is 1,53,090 minus 15,309. So you'll get a balancing figure of 1,37,781. It is the current value of an asset is 1,37,781. So 31st/3/2017 by balance carried down. So you have to carry down that balance. Now how to wind up your machinery account? So they have asked us to prepare machinery account for 4 years. Now we are done with the entries for 4 years. Now at the beginning of the 5th year, that is in the 5th year, so you have to bring down the balance and end up the problem. So to balance brought down 1,37,781. That is whatever the amount you have carried down in the previous year. So you have to bring down that balance and stop the problem. So this is about machinery account. Now coming to depreciation account. So you know about depreciation account. So what is the entry? Depreciation account data to asset account. Other one is transfer of depreciation to profit and loss account. So your entry will be profit and loss account data to depreciation account. So normally I have told you depreciation is calculated at the end of the financial year. Now coming to the end of first year. So your format remains same. Date, particular journal folio amount in the debit side. Again date, particular journal folio and amount in the credit side. So how to calculate here? To machinery account. That is your entry will be depreciation to asset. So for charging depreciation to machinery account. Now what is the depreciation in the first year? So we have already recorded. See here, in the first year depreciation was 21,000. So write that 21,000. Next, transfer that depreciation to profit and loss account, that is end of the first year, 31st/3/2014 by profit and loss account 21,000. So both the side will be 21,000 and 21,000. So hope you are clear with the first year. Now coming to the second year end, that is 31st/3/2015 to machinery account. Now what is second year depreciation? It is 18,900. So write 18,900. And transfer that to profit and loss account. So 31st/3/2015 by profit and loss account 18,900. So both the side it is 18,900. Now coming to the third year also, third year end. So what is the date? 31st/3/2016 to machinery account. Now what is third year depreciation? So go through the machinery account. Third year depreciation is 17,010. So write that 17,010 here. Again 31st/3/2016 by profit and loss account 17,010. So you have to transfer that depreciation to profit and loss account. In the same way, fourth year ending also, that is 31st/3/2017 to machinery account. Now what is fourth year depreciation? That is 15,309. So transfer that 15,309. Now transfer this depreciation to profit and loss account 31st/3/2017 by profit and loss account 15,309. So both the side will be same. So this is how we are going to prepare depreciation account. But in case of straight line method, all the year the value of depreciation will be same unless if they have sold the machine in between or they have purchased the machine in between. Other than that, the value of depreciation will remain same. But here in case of written down value method, the value of depreciation goes on diminishing because each and every year we are going to calculate the depreciation on written down value of that particular asset. So this is how we are going to prepare depreciation account. Hope you have understood the problem. That is, today we have discussed a 12 marks problem on calculation of depreciation under written down value method. In my next session also, I am going to continue with one more problem and we shall wind up this chapter. So, in next session, I am going to calculate depreciation under written down value method. So, we shall solve a 12 marks problem. That is, I have clearly told you, in your examination, they might ask straight line method for 12 marks or written down value method for 12 marks. That is where you have to prepare machinery account or asset account as well as depreciation account for 12 marks. So in my next session, we shall continue with one more problem and we shall wind up this chapter. So my dear students, hope you have understood the session. See you all in my next session with a new problem. Till then, take care. Thank you.